guys are at M&A Done Right. Today's session is going to be a Q&A format that's focused on mergers and acquisitions in the Microsoft channel. We are fortunate enough today to have an esteemed panel of experts, folks that we have had the been fortunate enough to work with over the years. I'm not going to steal any of their thunder. For all of your benefit, I am your moderator, Mike Harvath, President and CEO of Revenue Rocket. If you'd like to learn more about us, feel free to look us up at revenuerocket.com. I think anyone that's in the room should know this stuff. My marketing person convinced me that said if we're boring to stay connected via the Wi-Fi with the password. So if you guys need to log on, or if you're not here, specifically registered and inspired, because we certainly have some visitors that have come just for this event, feel free to log on accordingly and you can learn more about us. So without further ado, I will introduce our first speaker, Axel. Maybe you can just give us a little background, sort of what you do and where you're from, and what you guys do with it.
Yeah, thank you, Mike. Yeah, my name is Axel Schulz. I'm managing partner of EUROCON. By the name EUROCON, you can maybe already guess that from Europe. We are an M&A advisory company from Germany. We do projects focused on Microsoft Partner Network in Europe.
Great, thank you, folks. Linda?
Good afternoon, I'm Linda Rose. I was a partner in this ecosystem for 25 years. I've recently retired and I've written a book. We'll talk about that more later. But have been through two sales in the last 5 years. I've sold both of our organization, consulting dynamics for our organization, and a cloud hosting infrastructure organization. We learned a lot in that process and hope to share that knowledge with you guys here today.
Mike Reinhart. I am CEO of Quisitive. We are a national systems integrator partner with Microsoft across North America, both the US and Canada. I'm one of you. I've been in this business. I have a pin that says I've been with over 20 of these. I actually was at them when they were called Stampede before they actually became Worldwide Partner Conference. So I've been doing this a long time. I've been very actively involved in the ecosystem, but heavy on buy side. Got several buy side transactions in the process of bringing together my vision of the partner of the future. We'll kind of talk about some of the elements of that, but we're really trying to create a fabric where organizations can scale and come together and consolidate through acquisition, but also create a unique connection with Microsoft that we'll talk more about.
Great, fantastic. Kyle?
Is it on? Oh, it is. Hi, my name is Reesing. I'm a principal at a firm called Strattam Capital. We're a technology-focused private equity firm focused exclusively on investing in business IT. And we define business IT as basically enterprise software, data services, information services, and tech-enabled services, where I would kind of put the Microsoft ecosystem. We've got about $450 million in management, focused on investing in companies that have between 10 and 30 million in revenue, kind of sub 5 EBITDA, typically founder-owned, founder-led, where growth is kind of in the 10 to 20% range. And we bring what we bring to the table is really the ability to help you scale your business, taking it from 15 million in revenue up to 100 over the 5-year partnership that we'll look to set up for. And happy to provide more information as we get going here about how we work with you guys and founders like yourselves and helping you scale your business.
Great, Brent. Brent?
I'm Brent Combest. I'm actually with Microsoft. I've been in and around the channel for the entirety of my career. I spent about 7 years actually working out for Dynamics Partners before I came to Microsoft 14 years ago. My current remit is I look after about 50 or so partner development managers around the US. That spans the national systems integrators, the MSPs, and then more of the regional partners that focus on the entirety of our 3 clouds across Dynamics, Microsoft 365, as well as Azure. And I'm passionate about partner profitability. I've done and led a lot of the research at Microsoft on what makes partners tick and sharing of the best practices around the world in partnership with IDC and Gartner and a few others. And M&A is also passionate about as well.
Great, thanks, Mike. A few housekeeping items for you. We have some snacks and beverages on the side. We are fortunate enough to have Linda Rose here today. As she introduced herself, she's written a great book on M&A that she will be signing and giving away a few copies in the next hour. We also will have some additional beverages, adult beverages, actually brought in at about 3 o'clock. So if you can stay to network a little bit afterwards, feel free to do that. And certainly most of us will be here most of that time into today. This is a unique format in that we are going to treat it as predominantly a Q&A format. Normally when we do these types of presentations, we typically will present lots of slides and talk about a certain M&A aspect of M&A. Today we're going to open it up to you, the partners that have questions. Many of you submitted questions with your registrations on Eventbrite, so we certainly will be asking those questions. But I would encourage you to feel free to ask the question in your own voice. We have a microphone in the back of the room that will get passed around. It'll be helpful for all of us to be able to hear you, to get the microphone first to ask a question of our esteemed panel. We have probably 150 years of M&A experience sitting on this panel. Maybe it feels like years because we're in technology, but certainly lots of experience, lots of work that's been done, and lots of hard lessons learned. And we today want to really just facilitate that shared knowledge. So with that said, I will open up the floor to questions. If someone has a question and would like to ask it, please raise your hand. We will give you the microphone, and the panel is yours.
I'm Charles Duff with Dynamic Shift. Whenever we go to the Dynamic Summit, they say the number of exhibitors is being reduced by consolidations. So I was wondering exactly what trends you see. What are the industries? We know in the dynamic space they're combining. So what do you see in the Microsoft ecosystem as the merger or acquisition opportunities?
Well, I'll present that to our panel, our esteemed panel. Axel, and maybe you can provide a European context.
Yeah, thank you for the question. It was a little bit difficult to understand, but as far as I understood it, it's about what trends do we see, what drives M&A these days in the Microsoft Partner environment. I think, first of all, the technology stack is a big driver because, as you all know, it's over the last 2-3 years, really that you need a much broader offering to the clients, like this end-to-end offering to really give the client the right services. And this is, at least in the European network, a big driver because very few partners do have this end-to-end offering to the client. Another big driver is that, again, from a European perspective, Microsoft has plenty of very small partners. And this is something, I would say there's no room for small partners as long as they don't have a very, very special niche. Then they maybe can survive in that niche. But what is in the past, like we have thousands of business, or now Business Central, back then it was NAB partners, who just have an offering ERP. But these times are gone or will be gone soon. And we have a third driver, especially these partners, Microsoft partners. We now see also that the IT partner industry, we saw a lot of companies were founded in the 70s and 80s. And we now see the thing that the owners would like to retire. So these are the three drivers I see personally from a European perspective.
Great, thank you. I'm going to pull a question from the stack that you guys submitted early on, and I'm going to pose this question specifically to Kyle. Kyle, there was a question that said, what do investors value most, and how should a partner think about finding the right investor to help them scale their business?
I would say one thing that we've been actually kind of focused on at Strattam is finding I would say somebody that has proprietary IP. So we view Microsoft as a platform. It is ubiquitous, it is everywhere, and so your ability to find a niche within a specific industry or specific workflow, where over the next, or over the last or next 10 years, you can develop a real proprietary knowledge, technology yourself, that creates basically, in my opinion, the most value for you. Because now you're not just an integrator, you're not just a services provider, but now you have something internally that is valuable to your company, that an investor can basically say, hey, I'm gonna help you scale this, whether that's a geographic focus, whether that's expansion into a new industry vertical. From our perspective, that's what we value in the highest regard. We've now made 2 investments actually behind that thesis. The most recent being a company called Rock Solid Technologies, which is actually based in San Juan, Puerto Rico. They started as a Microsoft partner doing implementation services around Nav, GP to AX, doing CRM deployments. They're moving to the cloud right now, but really what we saw as the value was they developed workflow around helping public sector manage citizen engagement to your 311 call centers, to your actual interactions with your citizens on top of Microsoft CRM. They also then had workflow for financial management to payroll capabilities built on top of Microsoft Dynamics ERP. And really it's that domain knowledge in the public sector and that focus that, hey, they've built something, they've got development capabilities and basically a nearshore cost center where we're now taking that to North America. They're getting a lot of traction. That is one example of what I would say is super valuable because that business over time, our goal is to basically make that into a recurring revenue subscription SaaS software company. SaaS software is going to get a much, much higher multiple of value than being a true just kind of systems integrator or implementation services firm.
Great. Yeah, Mike?
So I'll add to that because, again, I know one of the challenges, if you're like me over the years, unlocking that value that you might be aware of inside your organization is really hard to do. Your best and brightest are out delivering value to the customers, and how do you create the time, the investment, and other kinds of things to actually unlock that? So our approach is to enable that. So what we do is certainly looking for folks that we think have the concepts, the ideas, and the passion to do that, but then bringing them into our organization where we've got a labs kind of concept, we've got investment dollars, we've got mechanisms working through them with Microsoft to take advantage of things that they're doing to actually help organizations unlock that. Because that's been probably the biggest thing I see is there's lots of great ideas out there, but acting on them is so difficult for the traditional partner to do. And how do you really then create the value that you can get the return on? So that's one of the things that we focus real heavily on.
Yeah, great. Thank you. Do we have another question from the audience?
Okay, very close. My name is Wim Janssen, and I have a question for Linda. I just read the back of your book, and I saw that you sold 2 companies for 100% in cash. And I'm just wondering, why should an investor be interested to provide you 100% in cash while you're actually interested because of the value of the future? How does that work?
Sure. So I actually sold 3 companies over my life. 2 of them were Microsoft companies. The first company was a staffing firm, and I did get 100% cash for that. The second company was a Dynamics VAR organization, and it was a combination of cash, note, and earnout. The third company, and we'll talk about that for a second, was my cloud infrastructure business. I sold it to a private equity firm. I had 98% recurring revenue, a 97% customer retention rate. There was really no need for me to stick around. I sort of worked myself out of a job. The people that bought me said, you know what, we don't need you to stick around, so here's all your cash now. We can see that your revenue that you've produced in the past is going to move forward, and we can see that it's going to be guaranteed for us. We see growth. And so it's a combination of that recurring revenue and that strong customer retention that got me that, got them comfortable with me that I could just really walk out the door 45 days later with 100% cash. So that's where you want to go.
about the capital providers are able to get that?
Yeah, I'll just comment for us. I mean, we aren't likely in our approach to take that. We're looking for aligned interests. Our whole philosophy is around creating value together. And this is a people business, and usually you're a big part of why those people are there. If that's not well transitioned, first of all, you got to have cultural alignment. There's got to be that leadership. There's got to be likely you're exiting the business because you want to transition, so it's got to be an orchestrated plan thing. But for us, we want that to be very carefully understood. So for us, that would be an important criteria.
And that's normal.
Yeah. I would say, just to echo that, I mean, from our perspective, it really kind of depends on the scenario in a sense. If it's kind of a new platform, we're typically wanting to partner with the management team to help them scale that new platform. But within that, we're going to use M&A as a way to create immediate scale. So say we buy a company, it's got 20 million in revenue, we go out and we're going to go acquire something that's got 8. Well, the founder of that company that's maybe got 8 million, if they want to step away, day 1, day 0, we have no problem with that because we have a team in place, they're going to manage it, they're going to take over that customer base as long as you have, but what makes it attractive is what Linda said, is around what are the metrics of that business? Do you have good sticky recurring revenue? Do you have good customer retention rates? What are the real KPIs of the business, right? Is it world class, right? That's what we're looking for as far as finding value, especially if the team is wanting to step away.
Great, thank you. I'm going to address one of the questions you guys had submitted prior, again, to the panel. I'm going to ask Brent a question on his perspective. I think a very unique perspective of the channel today. What do you see as some of the M&A trends that are occurring in the channel, and what are the key value drivers for partners right now?
Sure. From the perspective of what makes them more valuable, and for us, I'll go out and I'll spend about half my time in the field meeting with partners, and that generally means in a given week I'll meet with 10 or 11 partners as part of a trip, and the conversation on M&A comes up at least twice, if not more, inside of that. So it definitely is a white hot topic both on the buy side and the sell side in there. As far as differentiation and value is concerned, it all starts with durable competitive advantage. How are you creating that? How are you separating yourself from the herd? And I actually track this myself amongst the portfolio. I've got about 800 partners in my portfolio today. And as an overall portfolio, that business grows at about 35 to 40 points a year. But the partners that I've met with that I know have specialization in their business, to the degree of what you're talking about earlier, their growth was 139% last year in terms of Microsoft revenue. So it's staggering to see the difference. And there's so much that goes into that. It starts to bleed into efficiency gains in the business, value of the message that lands with the market, influencers that carry their brand and their message for them. And you start to think about how they utilize their resources, whether it's billable resources or managed services resources, they just get better at how they do that. And it's not just about building for the cash event that this matters for, it's also about how you engage with Microsoft. If you sell into the enterprise space and you want one of our field reps to engage you and bring you into a deal, there's 3 vectors that they care about. One's geography, one is solution capability, but the third is verticalization. Because they think about in the morning when they wake up, I've got a problem for an AI solution at a hospital in New York City. That's how they think through the process, and they hunt partners that have a proven experience there. So that's kind of the dimension of how we think through it.
Great, thank you, Brent. So a question?
Yeah, I'm not sure who this would go to exactly, but what's the premium that would be paid for a platform company versus a roll-in company? Maybe it is for Kyle.
It really kind of depends upon really the metrics of the business and your specific capabilities, for sure. There are scenarios in a sense where we might pay a higher premium for a tuck-in because it has something that platform doesn't have, that you can't build, or it might just take longer to build, right? So that's that go buy it. However, there are also times where if it's not kind of a product extension, that's where I'd say you might get potentially more value because it has strategic relevance, right, to me as the buyer. The second one would be if it's really more of a customer-based acquisition, so more of a geographic expansion. Well, hey, we could move in over time into this geographic focus, but instead of that taking 2 years, we want to accelerate that and go buy a customer base. That's typically where we're buying down our multiple through that process, right? So that tuck-in is getting much less value than the platform because it's not at scale. And so it's really around, hey, we're just going to go acquire your customer base, your solution or your service set, we can do it better than you can. And so therefore it's, hey, I'm buying basically your customer list, and so I'm going to pay less for that than paying up for something that you do better than me from a solution or services standpoint, if that makes any sense.
Great. We have another question from the audience. A question here.
Yeah, I ain't gonna go for that much more. I'm Chris Osler. I don't know who this is for particularly. This is kind of an opinion question. So I'll give you the scenario and you can say, yeah, maybe. European company, 12 years as a Microsoft partner. We listened the last 4 or 5 years and everybody was saying all cloud all the time. So we took an on-prem app, rewrote it for the cloud, rapidly growing. We have a partner, North American partner, that drives 50% of the revenue for the company. Which, you know, we're here at Inspire, and it's all about partners, right? Celebrate partners. The acquisition advice from some advisors, and I'm going to say in Europe, just because I'm a little biased, say that that dilutes the value of the company because there's one partner driving so much revenue.
So the question is, in the opinion of the panelists, does that dilute the value of that?
Of the overall company, because they've got
company?
one partner doing so much. And we have partners in 40 countries.
Sure, I'll start with that.
Yeah.
So I would agree with that statement.
Okay.
In that you have a single point of failure for North America, plain and simple. It's almost like looking at your customer base as well, right? If 50% of your revenue came from one customer in North America, which in essence, your partner is your customer in a way, that just puts the entire organization at so much risk.
Okay.
Any further thoughts about that?
Yeah, I think this is, I agree with that. I think there's a rule of thumb, anything between 10 and 20% dependency on one client is something where people start thinking critical. Of course, it's something to turn around or to ask yourself, what is with the other 40 partners?
It's a different story. It's a different problem.
But this is exactly, do you see any potential in one or two of those to really grow also to a significant size? Because then you have with your now North American partner, the raw model, what you can tell that you can try to do it. But if you have these other 40 partners already for 10 years, and they are still small, it's difficult to convince anybody that they will grow next year. Next year is always the best year. So this is, I think, something. It's like thinking about M&A is about thinking your own company strategy. So people sometimes ask me, how can I prepare my company for being bought next year? So, well, manage the company well.
Right.
Mike, I'll ask this question under the lens of more of a services oriented consultancy, because I think the answer might be just a little different. We've certainly seen in the 500 or so partners we've worked with over the last almost 20 years that the type of partner, you may answer this question a little differently. People that do predominantly professional services tend to have a fairly high concentration, particularly if they work in enterprise. What we've seen, just to share some experience, is that many of them have upwards of 50% of their revenue less than 5 clients. And so I don't know if you have a different perspective on this, or from sitting in the chair of a buyer, because clearly you guys are doing deals, what you think about that.
Yeah, so there's lots of elements to it. I would say there's probably a general statement about discounting, but when you start to apply that, it's about what's the history of that relationship. You start to get into repeat versus recurring revenues and things like that, because the relationships still have value. I'm still a believer. The customer relationships still drive. And that the other things you do are value add that extend both your value to the customer, which if that's not your first point, it should be about creating value to do a transaction. That should be an outcome that just naturally happens because you create value in your enterprise, and you do that through creating great outcomes for your customers, creating great outcomes with and for your partner, in this case with Microsoft. Didn't like that. So, so that's part of it. But I do think you start to look at the makeup of those. And I would look at those customers and talk about how secure are they? What are the scope of services and the value? And could I start to, in an acquisition mode, could I start to bring higher value services through other acquisitions or other capabilities I have and use as a conduit? Much like he talked about acquiring a customer base, well, that could be a great avenue to provide a different set of services into that context, both IP or other, to do that. So it would be a different lens on that. Certainly if it's a third party doing it, then I don't have control of the customer, and that's a big flag to me, because now that relationship, set aside the contract, because again, there's terms there that might have a life, but the relationship is existing with that third party, and that I would have a hard time getting through that without saying I'm taking on risk.
Great. Other questions from the audience? Question in the back.
Okay, thanks. Hi, this is Jeff Rogers from Big Green IT, Rock, California. I've been struggling for the last year. Mike spoke last year a little bit between EBITDA and growth. We feel like we're in a little bit of a land grab, trying to get as much as we can from an Office 365 standpoint and Azure standpoint. So my EBITDA doesn't look that good at the end of the year because I'm spending a tremendous amount of money on growth and marketing and so forth. And trying to figure out where that balance is when somebody, the first question they ask is my EBITDA. And I'm like, well, I spend it all trying to get bigger and grow faster. So I don't know, just comments on that.
From our panel, comments about what do you value, revenue growth or?
Well, my first question would be what was your revenue growth?
Well, it's
working.
Yeah, because we actually have historically sold a lot of hardware as well, and what's great is our CSP growth was 104% last year, and most of that actually is in Azure, which is great for, which I'd like to see. So our growth overall, we were at 10 million, we grew to 11 million, but really the growth was where I want it to be, and it's in the recurring revenue side, so I don't know if I should even split those two revenues somehow to reflect that way, but anyway, just questions at our size of a business and how you look at that.
My perspective would be, as long as the investment in growth is working, continue to do it, because if you can scale, especially on the recurring revenue side, as you alluded to, right, is if you can continue to scale that at 100%, 50%, whatever it may be over the next couple of years, you can easily right-size your EBITDA to prep, in a sense, over a 12-month time frame to say, hey, this is the normalized EBITDA level you need to service this recurring revenue stream, and ask for a multiple upon that, right? And if they point to, oh, well, your historical EBITDA is not nearly the same margin it is today, well, it's because I was also growing 100%, right? So if you want, there's two folds, right? If the investment's working, I always say keep doing it, because if you can grow at 100% per year, invest in that, absolutely, because you can always cut costs to service that revenue to make sure to maintain it and create the value off of that down the road, right? So it's really about optimizing around when you're wanting to sell the business versus grow the business.
Our firm does hundreds, I don't know the exact number, but hundreds of valuations of partner companies a year. And we have a pretty strong opinion about what drives value. When you think of it from a buyer's perspective, and I'd be interested to hear on the panel, from Mike and others that have sat in the chair as a buyer, it's in many ways about internal rate of return, right? If you're going to buy a company, and I'll talk to some of that, you have to figure out a reasonable period to get your investment back. And for most investors, they apply a lens to get higher than a 20% IRR or less than a 5-year return on that investment. And what tends to drive value is their ability to get that figured out. And it's not as simple as a multiple of EBITDA. And you're pointing out a great point, which is, do we invest in growth? Do we maximize EBITDA? What do we do to maximize value in the business? At the end of the day, it really has much to do with the synergies with the buyer, ultimately post-transaction. And regardless of what's paid, can they get to a plausible IRR on the transaction?
Yeah, to the comment earlier, demonstrating the revenue growth is key, and meaningful revenue growth, right? That's not 10, 20%, it's 40, 50%, depending upon the base you're working on. But the other thing is the mix of revenue, right? Again, if you're transitioning from project services revenue that has a start and end, and you got to go find it just to replace it versus recurring, again, all that gets factored into a much more complex formula for valuation. So again, we would look at those things. What I see often, and look, I've been guilty of it in the past as well, we mask underperformance by calling it investment. And I'll start with be honest with yourself first. Don't allow yourself to convince that I'm gonna rationalize my underperformance by saying I'm investing in something. Because I hear it all the time. My team will come to me and say, well, I made an investment. I missed my target this quarter because I made an investment. Really? Let's unpack that. So again, I've been guilty of this. Like, I've made a lot of mistakes, been doing this a long time. And I've often had to go look in the mirror and say, are you really going to tell yourself that? So I think that I would start with yourself, and then obviously with your teams to make sure that that's not the case.
Yeah, if I can add on to that as well, I would agree 100%. I think I was a little guilty of that in the past as well. But as I went through and interviewed a ton of buyers and sellers in the process of writing the book, what I did hear constantly was this growth in recurring revenue. And so back to your example, let's say your revenue is at 10 million, and it's 10 million this year with 40% recurring revenue, but it's 10 million next year with 55% recurring revenue, and the bottom line is still the same, you still created value. You increase the value of your company. So if that's where your investment has to be, that's a smart investment to make, because that recurring revenue stream is going to speak so loudly to a buyer, to anybody that's acquiring companies here on this panel.
Great. Do we have other questions from the floor that someone would like to ask? Otherwise, I'll ask one of the questions from that you previously submitted. We had someone in the audience, I think that are here, is contemplating the sale of their business. And in contemplating the sale of their business, they would like to ask the panel, what things should they be doing now in preparation for a transaction, say, in the next 6 to 12 months?
Can I answer that from an accounting perspective?
Sure.
So in a past life, I was also an accountant. And not everybody here implements CRM or ERP. There's other people that do other things within the Microsoft ecosystem. But I'm even surprised at the people that implement ERP, how when it comes to looking at their financial statements, they're just all over the board. No proper matching of revenue and expense, a combination of cash and accrual accounting, no deferred revenue, prepaids don't exist, things get expensed in the wrong month. Getting your financial house in order is like number one. And maybe I'm an accountant, so that's where I come from, right? But every single buyer I've spoken to has said, look, if the financials aren't in a good spot, we don't even know where to begin. So I would say start there.
Yeah, and I think a buyer, if they have a discussion with you and they start to look at the financials and it doesn't start to tie out, then there's questions on all the other great stuff you are doing that will get discounted because there's a hesitancy there. So again, I think it's a really valid point. It's relatively easy to do, and it's just make sure that you have that tight on the front end.
Yeah, I think it's also about maybe change the perspective and try, if you're thinking about selling within 6 and 12 months, try to sit yourself on the other chair and think about what would you do, what would you expect being the acquirer. So do you have really a clear strategy? You hopefully have, but is it really something you have maybe to update? And of course it's the financials, but it's very often, I'm really surprised, and it's really for both sides, that it's so difficult for people to just change the perspective and look at your company from an outside angle, and then you will know what to do.
Great, thank you. Here's a question submitted regarding a buy-side question. There's someone in the audience that's contemplating buying a company, but they're wondering what they should do to prepare their company to do an acquisition. Are there things that they should be contemplating or doing today if they wanted to contemplate a transaction, looks like within the next year?
Well, I'll start with a few things. I mean, a lot of times we do some really great things. Just make sure that things like processes and methodology and things like that show that you can do it on a repeatable basis versus the one case study that you're going to highlight, we all have on our website, is really put those things together. Even if they don't have to be in this, super polished form, but at least demonstrate that you have a repeatable mechanism to do those things. The other piece is people. Making sure, understanding, kind of the key resources and making sure you understand, kind of where they fit into the picture, how you're gonna, are you gonna tell them, you're not gonna tell them. There are all kinds of things like that create a whole different mindset inside the organization that you have to be really careful of. So those are a couple things I think about right away, is making sure that I start to build up the value that shows how I can do it, but also recognize that I have a whole bunch of team members that how is it going to affect them, and is this going to be a good outcome? Is it going to be a good outcome for them both professionally and or financially as part of that?
I would also just say that integration is a big key point, right? So thinking about, right, hey, how are we going to actually migrate emails so that we're all on the same email platform, right? Website consolidation, when is that, what are you going to consolidate onto? Thinking of putting all that down in kind of a full process around every piece of the organization from a sales standpoint. The sales complement is going to change, right? What are we going to consolidate on? Marketing to finance, what systems integration are we going to do, right? And having that in a full integration plan, we do this across the portfolio around, hey, who's owning each process? What's the timeline, right? And then kind of what's the current status? And track that on a weekly, on a daily basis so that you make sure that things don't fall through the cracks, because time and time again, M&A doesn't necessarily, right? I mean, there's a term of the old saying, but M&A fails because integration fails, right? So integration is a key point, a critical point on making sure that the two organizations become one.
Great. Axel?
And I think you also need a story, because there are lots of buyers out there, but the potential seller wants to be part of a bigger story. And if you don't have a story besides preparing management and integration, you will fail. There are a lot of buyers out there, lots of cash, but they don't have a story, and they are simply not an attractive buyer for a good seller.
Great. I think, I'll sprinkle a little wisdom of the ages in here as well. Certainly, a seller is going to do as much due diligence on a buyer as a buyer is going to do on a seller. And I think, to Axel's point about having a story, that's critical. But also, you need to have many of the things that a seller would have in order to be a buyer. You need to have your financial house in order. You need to be able to be in a position to show value and to really further articulate how 1 + 1 = 3 in this scenario. Otherwise, that seller isn't going to agree, even if you get to a point where they seem to line up strategically and you guys seem to line up culturally and financially, which we think are the 3 key components of any M&A deal. If there's not enough there as it relates to the story, if you will, by the buyer, they're just not going to do that deal. Other questions from the audience as it relates to M&A done right?
I would like to bring a question to the panelists for the sellers. What's the timing from the time they go to the market to the closure you see? I think that would be helpful to look at the time, the months, how many days.
Yeah, good question. Mike?
It will really vary, but the quickest it's going to be is 4 to 6 months, typically from initial introduction through getting to know each other. Because again, to his point, it's buyer and seller due diligence that if done right. Certainly take longer. I mean, just depending upon whether you're ready or not. It might be that you have a conversation with somebody that's very interested, but you're in the middle of making investments to demonstrate growth, and you're going to nurture that dialogue, and the further you get in it, the higher value you might get from that. So, but that's been kind of my experience, that it's in that 4 to 6 month window typically.
Anyone else on the panel have a different opinion about that?
So the time frame for both my deals were very different. The sale to the strategic, which is the large CPA firm, I knew them well, and they understood the product that we were selling. So from a due diligence standpoint, it wasn't somebody coming in and not really truly understanding what they're buying, because that does happen, right? We know that. So that was fairly short, 4 or 5 months, maybe 6 max. On the private equity side, they had to educate themselves as they were doing the due diligence, and it took a little bit longer. The due diligence process took a little longer. It was a stock sale as well, so they took a little bit longer investigating all that, but they were learning in the process. It was their first deal into the Microsoft space, and they just didn't know everything they needed to know, and they were a bit cautious coming in. So I think it can vary for those reasons as well.
Great. Axel, you have additional comments?
Yeah, I have a little bit different opinion on that, because I just would like to highlight that this was when the first contact was already established.
Correct. Yeah, you stop when you're starting.
This is the shortest part, actually, and it really depends also. So I would think if you think about selling your business, if you start thinking right now, and you have to prepare yourself and everything, it's something it takes at least a year when you're really to finally signing this.
Sure.
So this is like we have the real process, but we have also like, for us, if we have the first meeting with a potential client, I always say like from the first meeting where we still figure out if this is really a case we can work on together until the signing or closing has happened, it's typically 12 to 15 months. Like with the overall process, finding the right, doing some research and everything. So process 6 months, I totally agree, but there's before and after.
No, great. We have a question here specifically, I'm going to start with Brent for this one, about market outlook. Market outlook for continued, how long do we feel, and you have a good lens on this, as do the rest of the panelists, feel that the market will stay what we'll call hot or buoy, M&A market at this point. And looking at your crystal ball, what do you think about that?
Sure, there was a big wave that happened early on because when we started to see a migration to the cloud, there was innovation in the business model, and that caused a bit of a stir in the market. Now it's more about staying ahead of the curve and thinking about where the gaps are for other partners. We talked about rounding out the solution. So as we think about forward-looking workloads like artificial intelligence as an example, right? That's a gap for a lot of partners today that if you can get out ahead of the curve, it can be a very attractive offering for someone to take and bring into their portfolio. I still think it's going to be relatively hot in waves for an extended period of time as partners go through these cycles of building their skills and their go-to-market strategies around these new technologies as they come out. The time between those waves seems to be shortening because of the innovation that happens in the market, so it'll be interesting to see if that creates a smoothing effect over time or if there's still kind of an ebb and flow that takes place. The big thing for me, though, even inside of thinking about the strength of the market there, though, is helping partners start to understand how to continue to maintain a growth trajectory that's sustainable. I run into this quite a bit where we get into a situation where a partner, the owner kind of reaches their own level of unconscious incompetence, right? They're not comfortable with going beyond a certain level, or they're not implementing the processes, the procedures, and the people that keep that trajectory going forward. And at that point, it becomes a question of what's the value, because this business can't scale without this individual, right? So it's a combination of staying in front of things, but also having the business acumen and the discipline about how you run your business to keep the trajectory going up and right for a long period of time.
Great. I've asked the same question to everyone on the panel. I'd love to get everyone's perspective on it.
I mean, just the overall M&A landscape, I think, is going to continue probably for the next 18 months as far as a wave, but there's probably definitely going to be at some point over the next 2 years a correction in the market that I think will slow down. But from an M&A standpoint, as long as you have a fantastic solution set and a fantastic business, there will always be buyers for your business. Multiples might compress, but there will always be buyers out there that will want to buy a fantastic business that is performing at a tremendous pace, right? Businesses are bought, not necessarily always sold, right? It's as long as you have the fundamentals there will always be a market for it. But it's just from a broader landscape, I think that we're definitely at a peak. I mean, multiples are crazy and obscene right now as far as things we're seeing in the market. I think that that's going to continue for the near term, but I definitely think that there's going to be at some point over the next 2 years, some sort of a correction.
Yeah, I agree with those comments. I think to Brent's point is kind of the focus around the evolution is the key. I think those that are, take managed services for example, those that were early to get into that wave now are faced with this challenge of creating sophisticated tooling as a component of their managed service offering to be dynamically leveraging and building that. Again, for those kinds of companies that are demonstrating that, I think there will be an ongoing market. It's those that reach a point and stall. That today there's still a very strong market for those companies. I think today that's a good place, but those that don't, I do think in the next 12 to 18 months we're going to start to see those companies have two challenges. One is there won't be buyers, but they're also going to see pressure, downward pressure on their opportunity in the market to continue to maintain, let alone grow. And that's the big challenge. I mean, it is changing so rapidly.
So I would agree with Kyle in many respects that I think we're good through 2020 in the sense that I see a very strong outlook. The Fed have again indicated they're going to reduce the interest rate, so I think that's going to spur more debt. There's plenty of equity out in the marketplace as well, but as a partner and having been in this ecosystem for 25 years, I had to reinvent myself multiple times. Brent knows, right? Reinvent and reinventing again. But, and if you at some point as you progress in your career, you get tired of reinventing yourself, right? You can't stay current with everything. And that's when you have to look inward and say, is it time for me now? And so not so much time it with the economy, because none of us can ever do that. We don't have a crystal ball. We can't figure out the right time. There'll always be a market for people with great companies that have great revenue and great EBITDA. But it's really looking internally to yourself and can you keep up and stay current and stay fresh. I think that's the more important question.
I totally agree with you. I think it's a lot about timing, but timing is not just in general what the market is doing, it's timing, where are you at with your company, or what are your perspective, what is your perspective. So I'm personally still positive for more than 18 or 24 months, at least from a European perspective, because I've followed the M&A market for almost 20 years now, and I always thought now it's overheated, and then there comes a new technology, and we have some different areas. So I've seen values going down already for some ERP companies in Europe, which are kind of outdated. I'm sorry, and others I see in 5 years still a great value. So I think it's a lot about individual timing, and it also has a company perspective, but also a very personal individual perspective. How do you feel about it? How would you like, where do you see yourself in your company? And always ask the question where I'm relatively to the market.
Great. We have another question here. There's a question in the audience. Take that question.
I'd love to get the panel's feedback. So we're talking to 3 different partners right now, small partners about acquiring. Not strategic, all their financials look identical, no growth, no EBITDA, but obviously it's a tight labor market. There's some benefit to us to acquiring the revenue and the resources. So I'd love to hear you guys' thoughts on when you contemplate a tuck-in like that, how do you value it?
Well, obviously you can do that. I mean, obviously labor markets, sometimes acquiring, and I assume they have some customers too. So combination of that. I mean, the valuation is tricky on those. Typically what I would do is have it be based on an outcomes-driven thing that we do together, because they don't have a ton of value in their business today based on what you just described there. So there would probably be a small amount that would be valued now, but giving them the opportunity that they buy into the vision that what you're bringing them is going to create lift and allow them to maybe get something closer to a market value a year, 2 years, 3 years out, or whatever that roadmap might look like, where for them it could be an outcome that they probably can't get today. That's how I would think about that.
I would definitely agree with that. I mean, if there's really no ability to value the business today, it's kind of hard to say, let me acquire your business for nothing, right? Just give me your business, right? But it's the pitch and the story, right, that you're selling of, hey, this is what we can do together that is going to create value for you and for all parties involved. So completely agree, actually.
maybe you can also just acquire just a majority right now and then have an option so that it's from the seller perspective more interesting to create the value in the future together with you, and then they have a clear defined option in selling the rest to you, or you can have a call option, and then this really, I have experience with this kind of deals, and this really worked well because it gives the seller like still the perspective, like being an entrepreneur, and you have a safer deal from your side.
So I'll add an observation that almost grab onto your question and ask one as well. My experience from an observational standpoint is there's a reason that these partners are in that state. And when you go and you consider to acquire them, there's a lot of strain and challenge in trying to turn that business around. In most cases, those partners have been around for a considerable amount of time and the resources are tenured and expensive. I'm kind of thinking back to my days as a partner. I'm almost more apt to say, I'm more assertive and aggressive. I can actually take the volume of customers through acquisition at a faster pace than I could to buy what's probably there, and those customers are more laggard in most cases and may not be susceptible to, or may not be as inclined to think about next generation technologies. And then I can be better at creating a recruiting, a training, a mentorship type of an approach for staff that I could bring that are less expensive from either the industries that I sell into or perhaps even younger, earlier in career folks, and create a path for them. And I may be better off just organically growing that than trying to buy something and get into a kind of sticky situation.
Great. We have a question here from a member of the audience that talks about process and advisors. It seems that this individual is contemplating buying some firms, but doesn't really know. They've had casual conversations with, maybe similar to your situation, they've had casual conversations with some firms, but they're looking to determine what is the best way to, what should the advisory team look like for them to have a successful outcome in the transaction.
So actually in part 3 of the book, I talk about advisors extensively. Your CPA, your attorney, and your M&A coach, advisor, business broker, whatever you want to call them, right? And those are, I call the big 3. When you go hiking, you have the big 3. Your sleeping bag, your backpack, your tent. You never consider doing a long distance hike without the big 3. You never consider a sail, if you're smart, without the big 3. Now, that said, you may need more than one kind of CPA, right? There's the guy that comes in and looks at your financials, and you might need to go through an audit or review because your financials are not in good order. That may not be the same person who's looking at whether this is an ordinary situation, ordinary gain, capital gain, depending upon whether you're doing a stock or an asset sale. So you need to understand the ramifications of that, right? Then if you are selling to the end customer, you've got some sales tax issues potentially looming if you haven't been doing it correctly. And so that's a different kind of CPA as well. So and sometimes you can embody all this in one firm, but you certainly cannot embody it all in one person because they're 3 very separate disciplines. So that's the accountant side of the house. And then of course you want a good M&A attorney, not the guy that incorporated you, not the guy that wrote, this guy or gal that wrote whatever nasty letter to your client to collect on funds. It's an M&A attorney. It's a different kind of attorney, right? And then depending upon, the type of organization you are, and we're all technology people here, you want an M&A firm or an advisor or coach who understands the space, can advise you, knows the buyers, can look after you during that process. Can you do it without all 3? Yes, you can. Many transactions are done without all 3, right? And usually what's not there is if one partner talks to another, they've known each other for forever and ever, they don't have the advisor in the middle. But I'm not always sure that's the best way to go either. I think always having a coach somewhere in the middle to have the ugly conversations is always good to have. So those are the 3 must advisors. I'm sure. Did you ask that question?
I would add this, that again, if you're thinking about selling your business, I would find a couple of business folks that you really trust and have business advisors, because this will become a really emotional and not purely intellectual process, and you need rails to allow you to make sure that you go through that, and because you may make an emotional decision I built this, these people are so important to me, I can't let it go. You could make the wrong decision that way, or the reverse is that you're so committed to doing, you might do the wrong transaction, whatever. So I would encourage you to do that as well.
Great, thank you. One question?
Hi, Ravi with ProSum. I'm curious from, as we operate over the next year, from a value creation standpoint, which Azure infrastructure technologies are more important or will be hot from a valuation standpoint in terms of automation, security, identity, infrastructure as a service, or really from a valuation standpoint, it's going to be more about recurring revenue. Thank you.
You want to talk about
Brent?
Sure, I mean,
a source perspective? Yeah.
I think the fundamentals of the transaction will matter, and they outline those very, very well. But on top of that, the supply and demand equation starts to come in, and how many of those partners that are out there do a similar offering into the market and have the fundamentals that you have. I think what's going to separate you is what's the long-term horizon for how you're building your business for future growth, and also how you're separated from the multitude of people that are out there today. That means the market is large. What piece of the pie can you take versus your competition out there? And if there's 30,000 partners in the US today transact on CSP, right? So that alone there is pretty negative, or that's pretty unimportant at that point. So you got to think about that. I think about it as a long-term strategy of creating a stair-step approach based on technology. If you're going down the path of security today, that's one of many. To me, security is how you set the foundation for the house. The next step is, how do I aggregate data? Once I aggregate that data and make it really tight and bring in third-party sources for it, how do I visualize that and make it relevant to an audience? And then how do I then take that data longer term and start to use that for things like machine learning and advanced AI type algorithms, and just continue on that journey of staying out in front of where everybody else is at. And that supply and demand curve hopefully stays way behind you at that point. And even the fundamental piece is good, but now you've got those other elements of there's really nobody else like me.
And there's one point where, all the things he's talking about there is not just being technical experts on those, applying them to a business problem. That, again, is creating value and stickiness and hopefully recurring revenues as a component of it as well. But that's the key piece, because infrastructure as a service is a commodity and being commoditized every day. So betting business on just infrastructure as a service kinds of things is very difficult to create value, but starting to light up advanced workloads and advanced services in the cloud and again connecting those to business value is where I see the real challenge for all of us, and it's what I face every day, trying to figure out our strategy and direction as we go forward.
Great, thanks.